Sudan International University, Faculty of Economics, Financial and Banking Studies, Department of Banking, Semester 7. Good evening, my students. Welcome to today's lecture on cybersecurity and risk management, one of the most important topics in modern banking and finance. As banking services continue to move from physical branches to digital platforms, cyber threats have become one of the greatest challenges facing financial institutions worldwide. Today, customers can transfer money, apply for loans, invest and pay bills using only a smartphone. While these innovations have made banking faster and more convenient, they have also created new opportunities for cyber criminals. Banks today are no longer protecting only physical cash stored in vaults. They must also protect digital assets, customer identities, confidential information, payment systems, and cloud infrastructure. Cybersecurity is therefore no longer just an IT issue. It has become a strategic issue that affects business continuity, customer trust, regulatory compliance, and financial stability. Today's lecture will examine cyber threats facing banks, different categories of cyber risk management in digital banking, the role of artificial intelligence in cybersecurity, practical examples from real banking environments. By the end of this lecture, you should understand how banks identify cyber risk, manage them effectively, and protect customers against increasingly sophisticated cyber attacks. Cyber threats in banking. Let us begin by understanding cyber threats. A cyber threat is any intentional attempt to gain unauthorized access to a computer system, steal information, disrupt operations, or damage digital infrastructure. In banking, cyber threats specifically target financial institutions because they contain valuable assets including money, customer information, payment systems, and confidential financial records. Cyber threats in banking may target commercial banks, central banks, mobile banking applications, internet banking platforms, credit card systems, ATMs, payment gateways, cloud banking platforms. The objective of attackers is usually one or more of the following: stealing money, stealing customer information, disrupting banking operations, demanding ransom, damaging the bank's reputation, obtaining confidential financial intelligence. Notice the definition on this slide. Cyber threats exploit weaknesses or vulnerabilities within information systems. These weaknesses may exist because of the outdated software, weak passwords, human error, or inadequate security controls. Cybersecurity, therefore, aims to protect three fundamental principles known as CIA triad: confidentiality, integrity, availability. So let us take, for example, confidentiality. Ensuring that information is accessible only to authorized users. Integrity. Ensuring that information remains accurate and cannot be altered without authorization. Availability. Ensuring that banking services remain available whenever customers need them. If any one of these principles is compromised, banking operations may be seriously affected. Let us come to the common cyber threats. Now, let us examine the most common cyber threats affecting banks today. And let us start by phishing. Phishing is one of the oldest and most successful cyber attacks. Criminals send fake emails or text messages pretending to represent legitimate banks. Customers are asked to click a fake website and enter their usernames and passwords. Once entered, criminals steal the customer's banking credentials. Example, a customer receives an email saying, "Your account has been suspended. Click here immediately." The website looks identical to the bank's official website, and the customer unknowingly provides login information to criminals. Second, malware and ransomware. Malware is a malicious software designed to damage computers or steal information. Ransomware is a special type of malware. It encrypts banking data and demands payment before restoring access. Several banks worldwide have temporarily suspended services after ransomware attacks. 3. Identity theft. Identity theft occurs when criminals steal personal information such as national ID numbers, bank account numbers, passwords, credit card information. They then impersonate the customer to conduct fraudulent transactions. Data breaches. A data breach occurs when confidential banking information is accessed without authorization. Examples include customer records, loan information, credit histories, transaction records. Data breaches often lead to legal penalties and loss of customer confidence. 5. Distributed denial of service, DDoS attacks. A DDoS attack overwhelms a bank's servers with millions of fake requests. As a result, legitimate customers cannot access online banking services. The objective is disruption rather than theft. Number 6, insider threats. Not every cyber threat comes from outside. Employees may intentionally or unintentionally compromise security. Examples include sharing passwords, copying confidential information, negligence, fraud. Number 7, ATM malware. Cyber criminals install malicious software on ATM machines. This allows criminals to steal cash or capture customer card information. Number 8, mobile banking attacks. As mobile banking grows, criminals increasingly target smartphones using malicious applications. Customers may unknowingly install fake banking applications. Number 9, social engineering. Social engineering manipulates human psychology instead of attacking technology. The attacker convinces employees or customers to reveal confidential information. Last, credential stuffing. Many people reuse the same password across different websites. If criminals obtain passwords from another website, they automatically test those passwords against banking websites. The impact. Cyber attacks produce serious consequences like financial losses. Banks lose millions through fraud, ransom payments, system recovery, and compensations. Reputational damage. Customers lose confidence, so rebuilding trust often takes years. Customer distrust. Customers may transfer their accounts to competing banks. Regulatory penalties. Governments impose heavy fines when banks fail to protect customer information. Operational disruptions. Cyber attacks may temporarily shut down ATMs, internet banking, mobile banking, payment, payment systems. Business operations may stop completely until systems are restored. Risk management. Risk management is much more than responding after an attack occurs. It is a continuous process. Banks continuously identify, measure, evaluate, control, monitor, and reduce risk. Risk management aims to protect financial assets, customer information, technology infrastructure, banking reputation, business continuity. So an effective cyber risk management framework includes security policies, internal controls, risk assessment, employee training, incident response plans, regulatory compliance, continuous monitoring. So cybersecurity is therefore both a technological and managerial responsibility. Let us come to the major risk in cyber banks. The first one, or digital banks, face several categories of risk. The first one is cybersecurity risk. This includes phishing, ransomware, malware, DDoS attacks, hacking. So this is usually the most visible category. The second one is operational risk. Operational risk arises from failure in people, systems, internal processes, external events. Examples include system failures, employee mistakes, cloud outrages, software failures, financial risk. Banks continue to face traditional financial risk, and these include credit risk, financial risk, and banks continue to face traditional risk. This includes credit risk, borrowers fail to repay loans, market risk where financial markets fluctuate, liquidity risk where banks cannot meet short-term obligations, interest rate risk where interest rate change which affect profitability of the banks, and we have fraud risk, and fraud involves illegal activities intended to steal money. Examples: identity theft, payment fraud, account takeover, and insider fraud. We have also technology risk. And technology itself introduces new risk. Examples includes artificial intelligence errors, software bugs, API vulnerabilities, cloud service failures, third-party vendors. So banks increasingly depend on external technology providers, making vendor management extremely important. We have also compliance risk, where banks operate under strict regulations, and the examples of compliance risk include anti-money laundering, know your customer, privacy laws. Failure to comply may result in severe financial penalties. Number 7, reputational risk. Reputation is one of the bank's most valuable assets. One cyber attack can permanently damage customer confidence. Even if financial losses are recovered, public trust may not be covered. Or before this, we have to talk about automating incident response. Artificial intelligence automatically isolates infected systems, blocks malicious traffic, and alerts security teams. We have also credit risk assessment, where artificial intelligence analyzes customer behavior, financial history, and spending patterns to improve lending decisions. We can also use it for compliance monitoring, where AI continuously checks whether transactions comply with anti-money laundering and KYC regulations. Also, it reduces false positives. Traditional systems often generate unnecessary alerts, so artificial intelligence significantly reduces false alarms, allowing security analysts to focus on genuine threats. Let us review today's lecture by solving these matching tables. I encourage all the students to answer these questions before looking at the correct answer. So rather than memorizing definitions, focus on understanding why each concept is important. Ask yourself, why is phishing so successful? Why is social engineering dangerous? Why is compliance risk important? And how does artificial intelligence improve cybersecurity? These questions reflect situations you may encounter in real banking environment. Before we conclude, let us summarize today's key points. Today we learned that cybersecurity has become one of the highest priorities in modern banking. Cyber threats include phishing, malware, ransomware, identity theft, DDoS attacks, insider threats, and social engineering. Cyber attacks can result in financial losses, reputational damage, operation disruptions, regulatory penalties, and loss of customer trust. Risk management is a continuous process involving the identification, assessment, mitigation, monitoring, and control of risk. Digital banks face multiple categories of risk, including cybersecurity, operational, financial, fraud, technology, compliance, and reputational risk. Artificial intelligence is transforming cybersecurity by enabling real-time fraud detection, predictive threat analysis, automated incident response, improved compliance monitoring, and more accurate risk assessment. As digital banking continues to evolve, cybersecurity will remain a critical factor in ensuring the safety, reliability, and sustainability of financial services. Future banking professionals must therefore understand not only financial concepts, but also the technological risk that accompany digital transformation. Thank you for your attention. In our next lecture, we will continue exploring emerging issues in banking and finance and examine additional technologies shaping the future of the financial industry.